Ladies and gentlemen, most people ask what silver is priced, but the real question is how many ounces do you actually own? Because when the monetary system shifts, price becomes meaningless. Ounces become everything. In 2026, we're not just looking at higher silver prices, we're looking at tightening supply, rising industrial demand, and a potential revaluation moment. The investors who focused on stacking ounces, not chasing headlines, are the ones positioned ahead of the curve. So the real question is simple. How many ounces of silver are you holding? Most investors are trained to think in price. They watch the chart, refresh the market, and measure success in currency terms. But that mindset keeps you trapped inside the very system you're trying to hedge against. The more effective approach is to stop thinking in price and start thinking in ounces. Price fluctuates daily, sometimes violently, but ounces remain constant. 1 oz today is still 1 oz tomorrow, regardless of what the currency is doing. When you shift your perspective from price to accumulation, the entire strategy changes. You stop worrying about short-term volatility and start focusing on long-term positioning. The reality is that currency is the variable, not silver. When currency expands, purchasing power declines, and assets denominated in that currency appear to rise. Many people celebrate when silver moves up a few dollars, but the deeper question is whether silver is actually becoming more valuable or whether currency is simply losing value. When you count ounces, you remove that illusion. You begin to see silver as a form of stored labor and stored purchasing power rather than a speculative trade. That mindset removes emotion and replaces it with discipline. Short-term traders are constantly trying to time the perfect entry. They want to buy the bottom and sell the top. That approach sounds attractive, but in practice, it causes hesitation. When price dips, they fear it will drop further. When price rises, they wait for a pullback that may never come. Meanwhile, the number of ounces they own never grows. Accumulators operate differently. They recognize that the long-term trend is driven by structural forces, monetary expansion, industrial demand, and supply limitations. Instead of trying to predict every move, they steadily convert currency into ounces. Over time, this reduces timing risk and builds a meaningful position. Another factor often overlooked is the size of the silver market. It's relatively small compared to other financial markets. That means when capital begins flowing in, the move can be dramatic. Waiting for confirmation often results in chasing higher prices. By the time the headlines appear, the easy accumulation phase is usually over. Counting ounces encourages action before the crowd arrives. It emphasizes preparation rather than reaction. When you already hold physical silver, volatility becomes less threatening and more of an opportunity to add. There's also a psychological advantage. When your focus is price, every decline feels like a loss. When your focus is ounces, a decline can be viewed as a discount. The same movement creates two completely different emotional responses depending on your mindset. This is critical because emotion is often the biggest enemy of investors. Panic selling during corrections and buying during excitement are common mistakes. Measuring success in ounces creates consistency. It removes the need to constantly interpret the market's mood. Consider purchasing power across time. Historically, silver has preserved value in ways currency has not. While currency units change, tangible assets maintain utility. When you think in ounces, you're essentially thinking in terms of what those ounces can buy in the future. That's a more stable reference point than measuring everything in a currency that is continually being diluted. The objective becomes simple: accumulate a store of value that stands outside the financial system's volatility. This approach also aligns with long-term supply realities. Mining production doesn't increase quickly. Bringing new supply online takes years, sometimes decades. At the same time, industrial demand continues to expand in multiple sectors. That creates a structural tension between supply and demand. Price will eventually reflect that imbalance, but waiting for price confirmation defeats the purpose. Accumulating ounces ahead of that shift is a strategic advantage. Another important consideration is accessibility. Physical silver remains one of the most attainable, tangible assets. That accessibility allows gradual accumulation. You don't need large capital to begin. Consistency matters more than size. Small regular additions build a position over time. This method mirrors disciplined saving, but instead of holding currency, you hold a tangible asset. Over years, this can create a significant difference in purchasing power. When markets become volatile, liquidity can disappear quickly. Premiums expand, supply tightens, and availability shrinks. Investors who waited for the breakout often discover that physical silver is suddenly harder to obtain. Counting ounces ahead of time avoids this problem. You're not competing with late entrants during periods of stress. You've already secured your position. Ultimately, shifting from price to ounces changes the entire philosophy. It turns speculation into preparation. It replaces emotional trading with methodical accumulation. It acknowledges that currency is uncertain, while tangible assets provide stability. Instead of asking whether silver will rise next week, the more meaningful question becomes how many ounces you hold when the environment changes. Because when that shift arrives, the market won't ask what price you paid. The only thing that matters is the number of ounces you control. The silver market is unusual because it sits at the intersection of monetary demand and industrial necessity. Most commodities are driven primarily by one or the other, but silver carries both roles simultaneously. This dual demand creates a structural tension that becomes more significant over time. On one side, you have limited mine supply that cannot respond quickly to higher demand. On the other, you have growing industrial usage that consumes silver in ways that often remove it permanently from above ground availability. When these two forces begin to move in opposite directions, the imbalance doesn't correct smoothly. It tends to build quietly, then expresses itself through sudden price adjustments. Mine supply is not as flexible as many assume. A large portion of silver production is actually a byproduct of mining other metals such as copper, lead, and zinc. That means silver output often depends on the economics of entirely different markets. Even if silver demand increases sharply, miners cannot instantly increase production unless those primary metals justify expansion. This creates a lag between rising demand and additional supply. Bringing new mining projects online also takes considerable time, often many years from discovery to production. Environmental approvals, financing, infrastructure, and development all add delays. By the time new supply arrives, the market dynamics may already have shifted dramatically. At the same time, industrial demand continues to expand in areas that rely on silver's unique properties. Silver has the highest electrical conductivity of any metal, along with strong thermal conductivity and natural antimicrobial characteristics. These features make it difficult to substitute in many applications. As technology advances, silver finds its way into more components, often in small quantities that are not economically recoverable after use. This means that once silver is consumed in industrial products, much of it effectively disappears from the market. Unlike gold, which is mostly stored and recycled, silver is frequently used and dispersed. Energy infrastructure is one of the most significant drivers. Modern power systems increasingly rely on high-efficiency electrical components, many of which incorporate silver. Whether in grid expansion, electronics, or energy conversion systems, silver plays a critical role. Each individual unit may contain a small amount, but the scale of deployment multiplies demand. As global energy systems evolve, the cumulative effect becomes substantial. This type of demand is less sensitive to price in the short term because manufacturer requires silver to maintain performance standards. Devices continue to become more compact and more powerful, increasing the need for highly conductive materials. Silver is widely used in contacts, connectors, and circuit pathways. These components are essential to reliability and efficiency. Once integrated into consumer products, silver is rarely recovered. The result is a continuous drawdown of available supply. Even small increases in production volumes across industries translate into meaningful changes in overall demand. The medical and antimicrobial uses of silver also contribute to steady consumption. Its natural ability to inhibit bacterial growth has led to applications in coatings, filters, and specialized equipment. While these uses may not individually dominate demand, they add to the cumulative effect. The key point is that silver demand is diversified across many sectors. This reduces the likelihood of a single downturn dramatically reducing total usage. Instead, multiple industries collectively support ongoing consumption. Recycling does provide some supply, but it has limitations. Recovering silver from industrial products is often costly and technically challenging. When silver is used in tiny quantities across millions of devices, collecting and processing those materials becomes inefficient. As a result, a significant portion of industrial silver is not recycled. This contrasts with metals that are used in large concentrated forms. The inefficiency of recycling adds to the long-term tightening of supply. Investment demand adds another layer of complexity. When investors begin accumulating physical silver, they compete directly with industrial users for available metal. Unlike industrial demand, which is often predictable, investment demand can change rapidly. Periods of financial uncertainty tend to increase interest in tangible assets. Because the silver market is relatively small, even modest inflows of investment capital constrain supply. This is particularly true for physical silver, where inventory is limited and production cannot ramp up instantly. Above-ground stockpiles have also changed over time. Historically, governments held significant reserves of silver, but many of these were sold or depleted over decades. The modern market relies more on private holdings and commercial inventories. This shift reduces the buffer that once stabilized supply. When demand increases, there are fewer large reserves available to offset the pressure. The result is a market that can tighten quickly. The key dynamic is that supply grows slowly while demand can accelerate. This asymmetry creates a potential for sudden moves. Markets often ignore gradual tightening until a threshold is reached. At that point, price becomes the mechanism that balances supply and demand. Because silver's market size is relatively small, that adjustment can be sharp. The move doesn't require massive capital flows. It only requires demand to exceed available supply by a modest margin. Another factor is that industrial users typically prioritize availability over price. If silver is essential to production, manufacturers are more concerned about securing supply than negotiating small cost differences. This behavior can amplify price movements during shortages. Investment demand layered on top of industrial necessity creates a powerful combination. One group buys for protection, the other buys for production, and both compete for the same metal. Over time, these forces build quietly. Supply constraints don't always appear obvious at first. Inventories slowly decline, lead times extend, and premiums begin to widen. Eventually, the imbalance becomes visible. By the time it's widely recognized, the adjustment is often already underway. This is why the silver market tends to move in bursts rather than gradual trends. The underlying pressure accumulates until the system can no longer absorb it smoothly. When limited supply meets expanding demand, the outcome is not subtle, doesn't require extreme assumptions, only the continuation of existing trends. Slow supply growth combined with steady industrial consumption and periodic investment demand creates a structural setup. The timing is uncertain, but the direction is shaped by fundamentals. In that environment, the balance shifts toward those who understand that the market doesn't need overwhelming demand to move. It only needs demand to exceed what's available. Markets rarely move in straight lines, and silver is known for long periods of quiet consolidation followed by sharper pricing. What often gets overlooked is that these revaluation phases usually occur when multiple pressures build beneath the surface at the same time. Monetary conditions, investor psychology, supply limitations, and relative valuation all converge. When that convergence happens, silver doesn't just trend higher gradually. It tends to reset to a new level. The opportunity emerges before that reset becomes obvious. While the market still appears calm and interest remains limited, one of the most important signals is relative valuation. Silver historically moves in cycles where it lags behind other hard assets, then accelerates rapidly. During the lag phase, attention fades and participation declines. This is typically when the underlying fundamentals strengthen quietly. When the market eventually recognizes the imbalance, the move is fast because positioning is light. Investors who waited for confirmation often find themselves reacting rather than preparing. Revaluation is not just a price increase, it's a shift in how the market perceives the asset's role. Another factor is monetary uncertainty. When confidence in currency systems begins to weaken, investors start looking for alternatives that exist outside traditional financial structures. Silver occupies a unique space because it is both a monetary metal and an industrial resource. That dual identity becomes attractive during periods of uncertainty. If capital begins to move toward tangible assets, silver can respond disproportionately due to its smaller market size. It doesn't take large flows to create meaningful impact. This is why revaluation phases often appear sudden, even though the groundwork has been laid over time. Investor participation also plays a critical role. Silver markets often experience long stretches where retail interest is minimal. Trading volumes decline and the narrative shifts elsewhere. This environment allows accumulation without significant competition. The revaluation opportunity exists during this quiet phase. When attention returns, demand increases quickly, but available supply has already been absorbed. The result is a market that must adjust rapidly. This pattern is repeated across multiple cycles where the early phase feels uneventful, followed by a sharp move that surprises most participants. The structural characteristics of silver amplify these shifts because a large portion of supply is consumed industrially. Above-ground inventories can tighten without immediate visibility. At the same time, mining supply responds slowly to changing conditions. Investment demand increases, it collides with an already constrained environment. This doesn't guarantee an immediate move, but it creates the conditions where revaluation becomes possible. Markets often ignore tightening until availability becomes an issue. Once that threshold is reached, price becomes the balancing mechanism. Psychology is another important element. Many investors anchor their expectations to past price ranges. If silver trades within a familiar band for an extended period, that range begins to feel normal. When the market eventually moves beyond it, the adjustment can be dramatic because expectations were too narrow. Reevaluation challenges those assumptions. It forces participants to reassess what constitutes fair value. This process often happens quickly, especially in smaller markets where liquidity is limited. Capital rotation can also contribute. When other asset classes appear overextended, investors begin searching for undervalued alternatives. Silver's historical tendency to lag can make it attractive during these transitions. The shift doesn't require universal participation. Even modest relocations can have outsized effects. As capital flows in, momentum builds, drawing additional interest. This feedback loop is typical of reevaluation phases where initial moves create attention. Attention attracts further demand. Another dynamic involves availability of physical metal. During quiet periods, supply chains function normally and premiums remain stable. When demand increases, inventories can tighten quickly. Delays appear and costs begin to rise. This doesn't always happen simultaneously across all channels, but the overall effect is reduced accessibility. Investors who assume they could acquire silver easily at any time discover the conditions have changed. This reinforces the perception of scarcity and accelerates the reevaluation process. Timing these shifts precisely is difficult, but recognizing the setup is more practical. Reevaluation opportunities develop when multiple indicators align: relative undervaluation, limited investor participation, steady industrial demand, and constrained supply growth. None of these factors alone guarantees movement, but together they create pressure. Markets can ignore pressure temporarily, but not indefinitely. When the adjustment occurs, it often happens faster than expected. The nature of silver also contributes to volatility because the market is smaller. Liquidity can thin during periods of rapid movement. Price must travel further to match buyers and sellers. This creates the sharp upward moves that characterize revaluation phases. These bursts often surprise those who assume gradual appreciation. The move reflects not only increased demand, but also the absence of available supply at previous levels. Revaluation is ultimately about perception changing to match reality. When the market recognizes that supply is tighter, demand is stronger, and valuation is low relative to fundamentals, price adjusts. The process can be uneven with pullbacks and pauses, but the overall shift establishes a new baseline. Afterward, the previous range often appears undervalued in hindsight. Participants who positioned early benefit from the reset while late entrants focus on catching momentum. What makes this type of opportunity distinctive is that it develops quietly. There is rarely a single catalyst. Instead, multiple factors build gradually. The market may appear inactive, but underlying conditions are evolving. When alignment occurs, the move reflects accumulated pressure rather than sudden change. Understanding this dynamic allows a different approach, preparation rather than reaction. Instead of waiting for confirmation, the focus shifts to recognizing when conditions favor repricing. Once revaluation begins, the narrative tends to shift quickly. Attention increases, participation grows, and expectations adjust. What was once overlooked becomes widely discussed. This transition reinforces momentum.